I'm Henrik Cronqvist, and I'm the Dean of the Argyris College of Business and Economics at Chapman University in Southern California. And today, I'm super excited to be with one of our professors, the Burra Executive Professor of Accounting, and also retired partner from Deloitte, Hank Adler. And we will talk about what Professor Adler has characterized as perhaps the most important tax case in nearly 100 years. So, Hank, why is that? Why do you say that?
Well, it's a really interesting case. There was a family named Moore up in the Washington area, and they invested about $40,000 in a Indian company back in 1990 something, early 1990s, and that was it. They owned 11% of the company that they purchased. He may or may not have been on the board for a short period of time, but during their ownership through 2017, they received no dividends and had no activity whatsoever on a financial basis with the company. So in 2017, we have the Tax Cuts and Jobs Act. And one of the many provisions in that bill was a bill that taxed retroactively all of the income made by the corporation times the Moore's share into their tax return. So they put up $40,000. Nothing happens for a considerable period of time, years and years and years, and they get a tax bill for $14,000. So not a significant amount of money, but a very, very significant tax event that no one, I don't think anyone could have expected. And maybe one of the interesting parts of when they pass a tax bill these days, they're really required to be break even over 10 years. And my supposition has always been, this has been kind of the let's break even, let's catch up here, the bill will pass. And really 95% of the people in the position of the Moores were just thrilled, because the dividends to be received in the future were going to be tax-free, and the amount of money, and the tax rate that was involved was incredibly low. So if you were a major international corporation and you had the opportunity to refund into the United States a couple $100 million of tax dollars and pay a very low rate, it was victory. It was just the greatest thing that ever happened. So there wasn't a lot of talk about it at the time. So that's kind of a summary of where it started.
So Hank, this case, Moore versus the United States, it's now in the Supreme Court. It was taken up for hearing. So tell us a little bit, how have you been involved in the case so far?
Well, with my colleague, Lacey Willis, we wrote a piece literally in 2018, fairly shortly after the bill was passed. And, what do you do as professors? I mean, we read the bill, we became very interested in it. And as you said a minute ago, in September of 2018, we wrote a piece for, I think it was Tax Notes, that we entitled The Worst Tax Precedent in 100 Years. So this started as pure intellectual interest. It grew over, what is now half a decade, where we wrote several articles, several Wall Street Journal pieces I wrote with different authors over a period of time, and long talks with the lawyers that represented the Moores when they finally got the case to the Supreme Court.
Got it. Now, let's break down the case a little bit. So there's sort of three parts to it. So let's start with the first one, which has to do with quote unquote realization. And this may be a little bit technical, but help us out here, Hank. What do you mean by realization, and how is that manifested in the Moore case?
Okay, one of the basic rules of taxation is there has to be a transaction or an event where the taxpayer something has occurred. Doesn't have to be for cash. We can trade, we can barter transactions, but for the most part in the code, there's a history goes back to the 1930s, a case called McCumber, another case called Glatchow Glass. Nobody cares about the names of the cases. But those cases confirmed that there needed to be a transaction. Now, over the years, particularly because of international taxation, there had been some what would I call it? Slight changes to that theory, where if an international company moved money back into the United States but kept it in the original corporation, the government would say, I think rightfully so, that that's the same thing as getting a dividend. But the basic rule is there has to be an event or a transaction. And here, no transaction whatsoever took place. They just got a tax bill.
Got it. So the first aspect of it is sort of the realization. The second aspect is retroactivity. And so sort of the idea that the government cannot just wake up one day and say, hey, 25 years ago, you should pay tax on whatever happened back then. So how is that discussed in the Moore case?
Well, it's interesting. It's discussed when you get to the Supreme Court, there is you go to the district court, you go to the appeals court, and you raise all the issues. And when you head to the Supreme Court, you tend to narrow in. So when the lawyers got to the Supreme Court, they only appealed specifically to the realization issue, specifically to the realization issue. And the court was not asked about retroactivity, which we believe was just unfortunate that it didn't get that far. But let me explain what happened. Let me give you the full-on ramifications of it. The Moores were in the deal from the 90s. The law itself said that they were going to include in the Moores tax return their percentage of the Indian company's income from 1986 forward. Now, they weren't involved prior to 1986. And you kind of put your hands up and you say, well, that can't be. I mean, can government, as you said, and as we said in one of our articles, can they wake up on Tuesday morning and say, we want income back to 1986? So that's pretty offensive concept. Let me give you an example, and then I'll give you a little history of the law, which is kind of interesting. Under the Moore case, using both the realization concept of Moore and the retroactivity, literally, we could go back and Congress could go back and wake up another Tuesday morning and tax every shareholder of every New York Stock Exchange company since 1913, when we passed the 16th Amendment. And one of the oddities that wasn't part of the Moore case, wasn't discussed in the Moore case, is if the Moores had bought their shares in 2014, they still would have been liable for all that income that was earned before their ownership. Now, the court piece of that is I think, fascinating. There was a court case by a fellow named Jerry Carlton, who's a local fellow in Orange County. And after the 1986 Act, there was a section in that bill that just nobody thought through as carefully as Jerry, who's an incredibly smart guy. And he had a client, he just ran a truck through what was obviously just a mistake in the 86 bill. And Congress, about 16 months later, modified the law retroactively to 1986 and threw out his transaction. Bad answer for Jerry, who's brilliant, probably right answer in just, plain fairness. So we have a handful of cases that go retroactive when they're fixing a law. That was not the case here. There was nothing. They've changed the methodology, not important to anybody who's listening here right now, on how they want to tax foreign, but there was no correction of the law or anything. They just went back an exceptional period of time. And on a very individual basis, I'm hoping that the Supreme Court decides to look at that issue, even though it wasn't briefed. Chances of that happening probably aren't very good.
Interesting. So Hank, you have talked about the sort of an odd tax rate in Moore. So can you expand a little bit on that and also tell us about what you perceive to be the long-term potential effects of that?
Well, let me give you the third issue. The third issue is kind of fascinating. The last piece of the Moore case was that the Moores, they called this the mandatory repatriation tax. It's a unique tax. All taxes in the history of the code have either been regressive or progressive. Regressive meaning the same rate for everybody. progressive, meaning in the income tax world, the more you make, the more tax you pay. This tax was one of two rates, either 8% or 15%, 15%. And whether you fell into the 8% or 15% bracket on this amount of money you were being taxed on was dependent upon the liquidity of the balance sheet of the foreign entity. And that is unheard of. I mean, there's not a tax like that anywhere in the Internal Revenue Code. And of course, you start thinking about, okay, if they could tax on liquidity, what other things could leak into the code? Could I be taxed on my climate change, on my carbon usage, on my DEI? I mean, it just opens a huge range of things. I wrote an amicus brief strictly on that issue. But the issue did not, to be honest, the issue did not come up in the courtroom.
Interesting. Now, so Hank, when we will get a resolution on the case? When will the court make a decision here? Is that in the spring?
I think it'll be early summer. The way it works is the Supreme Court is required to rule by the end of June. So most of their important cases begin, and you see somebody from the local news station standing in front of the court every Monday morning for 3 weeks. So the last Monday in June is the 24th. I'm guessing we're not the most important case, but we're close. So I'm guessing June 10, June 17. There is absolutely no way to know. It's going to be a very, very difficult opinion to write. Let me explain to you why I think that'll be interesting to you. The problem with Moore, the realization issue, I think in almost any other context would have been very easy for the court. But in this context, the court, when they discussed the issue last week, they were very concerned about the implications of the Moore case on sections of the code that have nothing to do with Moore. And reading all the commentators in the last week and listening to the judges pretty carefully, I think they intend to write a very, very, very narrow ruling. I don't think they want to open up. You could read a win for the government as allowing in the future a wealth tax, an appreciation tax, and some other tax of that ilk. I can't picture a conservative Supreme Court trying to do that. Conversely, a big win for the taxpayer would preclude those things forever, which I think a couple of the members of the court would find terrific, but I don't think they're going to get 5 votes to do that. So it will be a long, long opinion trying to walk this narrow line of either being for the taxpayer, I hope, or for the government, but not opening up Pandora's box with a gazillion other issues that could be raised.
Well, Hank Adler is the Burra Executive Professor of Accounting here at Chapman University's Adler College of Business and Economics. Thank you so much, Hank, today for helping us out, breaking down a very complex issue, a technical issue related to tax, something that many are passionate about, and making it more simple for us to understand this interesting Supreme Court case. Thank you so much, Hank.
Well, great. Always fun to be with you.
Thank you.